The biggest risk to the American economy over the next 2 years isn't a stock market crash. It isn't inflation. It isn't even the next Fed decision. It's something that lives in spreadsheets nobody reads, buried inside loan documents most people will never see. And the reason nobody's talking about it is because it doesn't happen all at once. There's no single headline moment, no crash on a Tuesday morning. It happens quietly, one refinancing at a time, over the next 24 months. It's called the maturity wall, and it might be the most predictable financial crisis in American history, because unlike almost every other crisis, we already know exactly when it's coming. Here's the setup. Back between 2015 and 2022, interest rates were historically cheap. Real estate developers and property owners across the country took out commercial loans on office towers, apartment buildings, hotels, warehouses, all financed at rates around 3 to 4%. Most of these loans weren't 30-year mortgages like the one on your house. Commercial loans typically run 5 to 10 years, which means a huge chunk of debt taken out during that cheap money window is landing on the calendar right now, all needing to be paid off or refinanced at once. And refinancing today doesn't happen at 3 or 4% anymore. It happens closer to 6 or 7. That gap might not sound dramatic on paper, but on a $100 million office building, it's the difference between a loan that makes sense and one that quietly doesn't work anymore. According to the Mortgage Bankers Association, roughly $875 billion in commercial and multifamily debt is set to mature this year alone. And across 2025 through 2027, more than $1.5 trillion in loans will need to be refinanced, sold, or recapitalized. S&P Global projects the real peak isn't even this year, it's 2027, when maturities are expected to hit $1.26 trillion. This is not a guess. This is debt that already exists, with maturity dates already written into contracts. The wall isn't a prediction. It's a countdown clock that started years ago. So why hasn't this already caused a crisis? Because for the last 2 years, lenders have been playing a game some in the industry openly call extend and pretend. Instead of forcing a borrower to refinance at painful new rates, banks have simply pushed the deadline back, 12 months here, 24 months there, hoping rates would fall or property values would recover before the bill came due. And for a while, that worked. It kept properties out of foreclosure and kept losses off the books. But here's the problem with kicking a can down the road: eventually the road ends. All those delayed loans didn't disappear. They got rescheduled into this year and next year, stacking on top of the loans that were already scheduled to mature on time. Which is exactly why 2026 and 2027 look the way they do on paper, not because the crisis got bigger, but because 2 years of postponed decisions just arrived at the same door at once. Now here's where it actually gets personal, because this isn't just a story about developers and landlords. It's a story about who's holding the risk. The big banks you'd expect to be exposed, the JP Morgans, the Bank of Americas, actually have relatively modest commercial real estate exposure, somewhere around 13% of their total loans. But small and regional banks, the ones with less than $10 billion in assets, are a completely different story. Nearly half of their entire loan portfolios are tied up in commercial property. These are the community banks that fund your local strip mall, your regional office park, your neighborhood's apartment complex. And when a wave of commercial loans hits trouble at the same time, it's these smaller, less diversified banks that absorb the shock first. This isn't a hypothetical either. We're already seeing early signs. In Manhattan alone, the delinquency rate on office loans jumped more than 1,000% between January 2023 and January 2024. Distressed commercial property assets hit $116 billion in the first quarter of 2025, up 31% from the year before. And the office sector specifically is under the most pressure, for a simple reason: remote work permanently reduced how much office space companies actually need, so vacancy rates are sitting near 40-year highs. A building that was valued based on being 90% leased in 2019 might be 60% leased today, which means when it comes time to refinance, the appraisal comes back lower, the bank will only lend against that lower value, and suddenly the owner needs to come up with millions of dollars in cash just to keep the loan from defaulting. Multiply that scenario across thousands of properties, and you start to see the shape of the wall. But, and this matters, not every part of commercial real estate is in trouble. Industrial buildings and warehouses are holding up fine, with vacancy rates near record lows. Multifamily apartment buildings, while feeling some pressure from loans made during the frenzied pricing of 2021 and 2022, are fundamentally healthier than office. This is important, because the loudest version of this story oversimplifies it into commercial real estate is collapsing, and that's not quite accurate. This is a sector-specific stress test, concentrated hardest in office towers and older retail, layered on top of a banking system where the exposure isn't evenly spread. Some banks are walking into this fully prepared, others are walking in overexposed, undercapitalized, and out of runway. And this is exactly why almost nobody outside the industry is paying attention. There's no single company to blame, no CEO to drag in front of Congress, no dramatic ticker symbol crashing in real time. It's happening in loan servicing departments and regional bank back offices, one workout negotiation at a time. Analysts at CoStar have actually pointed out that most lenders don't want the bad press of a public foreclosure, so these situations tend to resolve quietly in negotiated sale here. A court-appointed receiver, they're the financial equivalent of a problem being handled in a backroom instead of on the evening news. Which means by the time this actually becomes a headline story, most of the damage will have already happened. So where does this actually leave us? The optimistic read is that this won't trigger anything close to 2008. Regional banks have already been reducing their exposure since the last scare in 2023. Rates may ease further, and most workouts really will happen quietly through negotiation rather than collapse. But the more honest read is this: for the next 2 years, we are watching a slow-motion stress test play out in real time, with the outcome still genuinely uncertain, sector by sector, bank by bank. Some regional banks will come out of this fine, others won't, and the properties that can't refinance won't vanish, they'll get sold, often at a steep discount, to whoever has the cash sitting on the sidelines waiting for exactly this moment. Because that's the quiet twist in every story like this. The same wall that threatens to wipe out an over-leveraged property owner is, to someone else with dry powder and patience, the buying opportunity of the decade. And that's the real reason this story doesn't trend. It's not loud enough for headlines, but it's reshaping who owns American real estate for the next generation, one quiet, unremarkable refinancing at a time.